Hello everyone and welcome to Educate 247. This is the 18th lecture in the series on financial awareness, and today we'll be covering SEBI revised norms for registered investment advisors. This series is important for SEBI Grade A 2020 examination. So before moving forward, Educate 247 brings you SEBI Grade A 2020 crash course, which features around 5,000 plus MCQs with concise content and live doubt sessions. To avail the benefits of the course, you can log on to the website and apply coupon code SEBI to get 1500 rupees off on the course. So coming to the news which is related to registered investment advisors, SEBI has brought in a slew of regulations to govern the registered investment advisors through a notification dated 3rd July 2020. Many of these changes were proposed by the capital market regulator in a discussion paper issued in 2020. So, how are investment advisors regulated in India? The SEBI Investment Advisor Regulations 2013 were modified on 21st January 2013 and came into effect on April 21, 2013. The regulations specify the conditions for registration, certification, capital adequacy, risk profiling, and suitability related to the investment advisors. In terms of the IA regulations, no person shall act as an investment advisor or hold itself out as an investment advisor unless he has obtained a certificate of registration from SEBI. So, what is investment advice? An investment advice is an advice relating to investment in purchasing, selling, or otherwise dealing in securities or investment products, and advice on investment portfolio containing securities or investment products, whether it is written, oral, or through means of any other communication for the benefit of the client, and shall also include financial planning provided that the investment advice given through newspaper, magazines, any electronic or broadcasting medium which is widely available to the public shall not be considered as an investment advice for the purpose of these regulations. However, investment advisors who make public appearance or make recommendations or offer an opinion concerning the securities or public offer through public media while making recommendations through the public media are required to comply with the SEBI Research Analysts Regulations of 2014. A bank or an NBFC who also proposes to undertake an advisory service has to obtain permission from the RBI and then make an application for grant of registration under the IA regulations through a subsidiary or a separate identified department or division. Now, coming to the news, SEBI has introduced client level segregation and barred providers from offering advice and distribution services to the same client. It has also increased the net worth requirements and tightened experience as well as qualification standards for the advisors as well as their employees. It has also introduced a mandatory threshold for corporatization. SEBI has also stopped non-registered investment advisors from using terms like wealth advisor or independent financial advisor to describe themselves. Now, coming to client level segregation, SEBI has mandated client level segregation of distribution and advice, which means a provider cannot offer both paid distribution and advice to the same client. For corporate registered investment advisors, the prohibition includes a bar on group entities such as subsidiaries who offer paid distribution to an advisory client. The RIAs can provide execution services, but they have to be free of cost and in direct plans. Some products, such as alternate investment funds, do not have direct plans, but SEBI introduced the concept of direct plans in others, like portfolio management services, in February 2020. Earlier, many corporate RIA firms at the high end would charge superficially low fees but would offer in house products or products from their associated distribution arms and thus rake in high commissions. The new rules will stop this practice. However, some experts feel that the new rules restrict individual RIAs from accepting distribution clients completely. The new rules were supposed to bring in parity between individual and corporate RIAs, but a plain reading of them shows that individual RIAs cannot accept even non advisory clients as distribution clients, while a corporate can do so through a separate division at an arm's length. Coming to the changes for advisors, SEBI has also hiked the net worth requirement for individual advisors from Rs 1 lakh to Rs 5 lakh and for corporate RIAs from 25 lakh to Rs 50 lakh. This has elicited some opposition from the industry professionals. The requirement for individuals at Rs 5 lakh is absent in professions such as law, medicine, and chartered accountancy. The regulator has also made it mandatory for an individual RIA with more than 150 clients to move to the corporate status. The SEBI notification also said that the principal officer of a corporate RIA or an individual RIA must have a postgraduate degree in specific subjects and 5 years of working experience relating to advice in financial products or services. Even an employee associated with investment advice should have a postgraduate degree or a qualification with 2 years of experience. The SEBI notification has barred anyone other than the RIAs from using terms like investment financial advisors and wealth advisors to describe themselves. Coming to the change in the advisory fee as well as status, with regards to the fees, a SEBI discussion paper in January 2020 had proposed the RIAs either charge a fixed fee of Rs 75,000 or assets under advice-based fee, which is being capped at 2.5% of the assets under advice. The SEBI notification did not include this proposal, merely saying that the fees will be specified by the regulator. Some RIAs have a minimum threshold of net worth before they accept themselves as fee-only clients, while others have a minimum fee amount. The SEBI notification will raise advisory standards in the industry, and the restriction on the nomenclature will help consumers to identify who are dealing with, though a lot depends on the enforcement of this provision. Regardless of what SEBI specifies for fees, the regulations on minimum qualifications could push up costs and make advice unaffordable for some people. The weak consumer sentiment due to COVID-19 may temporarily hold down costs, but these are eventually likely to move up as the industry will be forced to hire more expensive talent. Apart from the qualification norms, the prohibition on distribution services may also result in increased fees. The notification will also widen the gap between the regulations for advisors as well as the distributors. At present, there are only around 1400 registered investment advisors compared to more than 1 lakh mutual fund distributors who can also offer incidental advice. So that's it for this lecture, but prior to ending it, Educate 247 brings you a comprehensive course for RBI Grade B 2020, which covers topics related to economic and social issues, finance and management, along with the coverage of current affairs. So you can log on to the website to avail the benefits of this full video course. Thank you and happy learning.